Most traders sit in front of charts all day, jumping from setup to setup, wondering why nothing works. But institutions don't trade like that. They don't care about being active all day. They care about when liquidity enters the market. Real volume, real manipulation, and real directional moves happen when major sessions open. If you don't know when to trade, no indicator or strategy will save you. This setup uses LuxAlgo Sessions to focus only on London and New York because that's where institutions actually play, and it's built around one critical truth most traders ignore. The first 15 minutes of a session set the trap for everyone who trades after it. To add LuxAlgo Sessions correctly, keep your chart clean and distraction-free. Open your chart, click on Indicators, and search for LuxAlgo Sessions, then add it directly to the chart. There's no need to change or over-optimize the settings. LuxAlgo already highlights sessions with precision, showing exactly when each major market opens and closes. Make sure London and New York sessions are enabled and clearly visible, since these are the only two sessions this strategy focuses on. Once applied, your chart immediately separates meaningful market activity from low-volume noise, making it visually clear when institutions are active and when price movement is mostly random. The strategy is simple in rules, but powerful in execution. First, at the open of the London or New York session, switch to the 15-minute time frame and mark the high and low of the very first 15-minute candle. This range is not a trading zone. It is an information zone that shows where liquidity is being built and where early traders are getting trapped. Once that first candle closes and the range is clearly defined, do nothing on the 15-minute chart. Now drop down to a lower time frame, such as 5-minute or 3-minute, and wait patiently. You only look for trades after price breaks and closes above or below the first 15-minute high or low. The breakout itself is not the entry. It is the confirmation. After the break, you wait for price to either show momentum continuation or a clean pullback and rejection on the lower time frame. Then execute in the direction of the break. This approach ensures you are trading after liquidity has been committed, not inside uncertainty, allowing you to align with institutional flow instead of reacting to early session noise. The core rule of this strategy is absolute and non-negotiable. You do not trade inside the first 15-minute range. That range exists to trap impatient traders, not to reward them. Your job is not to predict what price might do, but to react only when price proves intent. You wait for a clean break above or below the range, because no breakout means no trade, and no confirmation means no entry. This single rule forces discipline, removes emotional decision-making, and instantly eliminates overtrading. By refusing to trade inside uncertainty, you stop guessing and start participating only when the market shows real commitment. This strategy works because it aligns with when institutions actually trade, not because of indicators, predictions, or fancy confirmations. You're not guessing direction and you're not forcing trades. You're reacting to liquidity expansion that naturally occurs at session opens. Time does the filtering for you, showing when real participation enters the market and when moves have meaning. That's why the focus is on trading less, but trading smarter. However, during high-impact news or major economic data releases, volatility can spike unpredictably, and session breakouts alone are not enough. In those moments, you must demand additional confluence, such as structure, higher time frame bias, or clear displacement, before entering. The edge comes from patience, context, and alignment, not from trading every move.